You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Wednesday. Sorry I'm a bit late today. I actually took an extra coffee on the terrace with my wife because it was a beautiful morning. So yeah, sometimes you got to prioritize stuff, right? All right, so why Stantec STN.TO, a small engineering firm in Canada, is up by more than 25%. Actually, as of this morning, before the market opens, total return year to date, 27.88. So almost up 30% year to date. For the past 12 months, we're talking about up 32.8%. And over the past 3 years, up 145. And you know what? The best part of that is you're still not late to the party. And let me explain that. So first, let's take a look at what Stantec. We're going to take a deep dive on the investment thesis, and then I'm going to tell you why it's up 27% and why it's not over yet. All right, so what's Stantec? Well, as I told you in the introduction, Stantec is an engineering firm. So they are helping multiple businesses and governments, mostly in Canada and the United States, but they also have exposure internationally, to do everything that is in regards to the construction of a project. So we're talking about evaluating, planning, designing the infrastructure, solution for transportation, community development, urban space. They do every single thing. What is good is that they go from the planning, the executing, the maintenance, and also the decommissioning. So they are present at each step of the infrastructure life. All right, so we're going to take a look at the narrative now. So what I like to do when I do the investment thesis, and this is how they have been shaped as of recently. We have upgraded this on Dividend Stocks Rock. So for each stock guard, for each company that we follow, we do have the investment thesis that is spread into 3 categories. So we have the general thesis, and then we have the playbook, the growth vectors, and the economic mode to help you simplify understanding the narrative behind an interesting company. So the playbook for Stantec, well, it's quite simple. The business is an engineering firm, and they serve multiple different segments. So 28% of revenue comes from infrastructure, 19% from buildings, 13% from energy and resources, 21% for water, and 20% for environmental services. What is interesting also to note is that 60% of Stantec revenue is coming from kind of like clean revenue sources. So everything that is about to build like LEED buildings, treat and recycle water, for example, and then environmental services. So it's a pretty strong trend as well. The other thing is Stantec will be able to help their client from A to Z. So from the start of the project, just the plan, to taking care of the infrastructure when you have to destroy it and build something new. So they have the expertise, the knowledge to do everything around that. So that's the playbook. Pretty much plain and simple engineering firms. There you go. The growth vectors now. So what is interesting about Stantec is they offer a mix of organic and growth by acquisition. So the growth by acquisition, they are buying small engineering firms, and when they do that, they also buy a book of client. And what is amazing with the book of client is then once you have like a complete infrastructure of services and several business units, as I just highlighted, well, it's easier for you to offer your business services from different units to those clients. So there is a cross-selling opportunity that is amazing. In terms of organic growth, well, you can see that 50% of their top 25 clients, they use 4 or more business units. In other words, Stantec is able, when they grab a client, it's able to offer them multiple different services depending on their needs at this point. But whenever they have a question about engineering, well, Stantec is able to meet those expectations and answer those questions. Now, the economic mode, like the fortress around the business, what's the competitive advantage? Not that much, actually. Besides the fact that they have like a good size and scale, they do have very strong client retention, and they also have long-term contracts. So it's kind of a protection, but it's not like a huge protection. They always need to fight to retain for the retention of their talents and to fight to get more contracts, obviously. So it's not there that they have the biggest strengths. So now that we have a very seductive narrative of a company that grows by acquisition, organically offers a bunch of services, what's up with the numbers? Why the stock is up more than 27%? And a lot of investors sometimes they think, well, it's up because it's up, the market is up, or we don't know. It's some kind of like a magical voodoo going around a stock. And then when you lose your mojo, the stock price goes down. Well, it's actually a lot more rational than that. It's a lot more driven by mathematics. If you look at the dividend triangle for Stantec, you would see that at Dividend Stocks Rock on the stock cards, we show like the graph for the past 10 years for the revenue trend, earnings per share trend, and the dividend trend. Well, the past 5 years numbers in terms of growth, we're talking about 9% for revenue, 12.75 for earnings, and 7.7 for dividends. So in other words, high single digit to double digit growth across the board. Now, is it that surprising that the stock is up double digit? Well, at this point, not really. What really drove the big jump this year is actually 2 consecutive great quarters in 2025. So the latest one actually showed revenue growth of 13% and earnings per share growth by 29%. So ironically, if the earnings per share jumps by 29% and the stock price follows about the same thing, you're literally paying the exact same price today than you would have paid 3 months ago. So that's kind of crazy, but that's how it is. So revenue and earnings are growing super fast. We have 6% from organic growth, 3% from acquisition. The rest is currency translation. So a big part of the 9% of the growth is coming from either organic or acquisition. They announced more acquisition during that quarter as well. And they also announced strong booking, actually record backlog of $7.9 billion of contracts signed already. And management says that they have a very strong pipeline going forward. So what the numbers are telling me is actually that all the numbers there are aligned with my investment thesis. And this is super important. When you have like a great narrative, a great story, you want to back it up with numbers. Well, I just told you how the company is great and it's growing and it's finding ways to grow even more. And when I look at the number, I tell you exactly the same thing. So then you know that you have a great match. Unfortunately, nothing is perfect, and I don't want you to jump on Stantec without doing your due diligence, but I'm going to also highlight a few risks before we go. So in terms of risk, well, at DSR on the stock card, what we like to do is to separate them into 3 categories. Business vulnerabilities. So what's the problem with the business? Industry and market threats. So external threat that could hurt the business that they have limited control over, and the competitive landscape to see like if we have like any other great potential companies in this field. So in terms of business vulnerabilities, well, of course, engineering firms, they are dependent on the economy, so it's quite cyclical. When the economy slows down, they will see their contracts slowing down as well. That's totally normal. They also have a relatively high dependence on government contracts. On one side, it's great because those are like large contracts, long term, so it provides like a stable source of income. On the other, whenever governments are cutting down on their budget, well, then boom, you will have a business that is hurting as well. So you see from time to time that revenue and earnings is slowing down, following simply the economy. In terms of industry and market threats, I would say one of the thing is like acquisitions, like the market could be tough. Sometimes you may be forced to overpay for an acquisition. There's a risk of integration as well. So that's one risk. The other one, and I think the most important one for me, is talent retention. It's one thing to have a great engineering firms, but when you think about that, it's driven by engineers. So if you don't have like amazing engineers, you don't have an engineering firm, right? So losing talent or being forced to pay them more more. So that would reduce the margin, would be one of the biggest risks for Stantec and one of the biggest break for their growth. And that goes along with the competitive landscape where you have in the exact same market in Canada, WSP Global. And WSP Global is a beast. It has like twice the size in terms of revenue and in terms of market cap, if I recall correctly. So big guy here. Probably easier for them to win larger contract and to acquire new talent. So that could be another risk. Of course, there's more to tell about Stantec than in 10 minutes, but it's a pretty good starting point for you to do more research. So don't take this as financial advice. Full disclaimer, I have Stantec in my portfolio and I'm obviously a happy shareholder, but I just wanted to highlight the idea for you and explain why what's the relationship between a stock that is up almost 30% and the numbers and the narrative. If you want to look for more companies like this, I suggest that you start your research with the Dividend Rockstar list. So the Rockstar list is a combination of all the companies showing positive revenue, earnings per share, and dividend growth over the past 5 years. It's a great start to get to narrow down your research only to the best companies that are thriving right now, and you can download it for free at moosemarkets.com/rockstars. So moosemarkets.com/rockstars. All right, Moose, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.